So there's so much excitement around the question of who the next Fed chair is going to be. Yesterday we had Stephen Myron, the head of the Council of Economic Advisors, nominated to the Fed board. There's talk that perhaps Kevin Hassett, the head of the NEC, perhaps Kevin Warsh, former member of the FOMC, could be the new Fed chair. And the market is betting that whoever it is going to move the dial and start delivering a lower Fed policy rate. But guess what? It's not the Fed which has the determining force on the cost of borrowing across the US economy. It's actually those bigger dynamics, the balance between saving and investment. And the big argument we make in our book is that that balance has shifted. And so it doesn't matter who the Fed chair is, borrowing costs are going to be structurally higher.
And you mentioned this earlier, that if the cost of money keep rising, what then should governments, businesses, and individuals do differently to maybe adapt?
So let's think about what impact very low borrowing costs have had in past decades. So first, for governments, when borrowing is cheap, then governments can keep on piling on debt and it's still sustainable. Think about equity market investors or property market investors. If you've put money to work in the US stock market or in US real estate pretty much any time over the last 4 decades, you've made quite a lot of money. And part of the reason for that is that interest rates have been low. So your cost of borrowing to make stock or property investments has been low. Now, with interest rates rising, all of those dynamics swing into reverse. For the US Treasury could be facing a world in the years ahead where the cost of interest payments on their debt is more than total US spending on the military, on defense, on the Pentagon. For investors in the stock market or the equity market, that upward pressure on asset prices from low interest rates, well, at a minimum, I think we can say that's not going to be guaranteed going forwards. And we could well be moving into a world where structurally higher borrowing costs actually mean downward pressure on stocks, downward pressure on real estate.
So, Tom, what can you tell us about, where is the natural rate of interest? Where is it headed?
So the focus of our book is on the natural rate at the 10-year horizon. Now, we think it's headed up from a low of below 2% in the mid-2010s to around 2.5% today. And it's going to continue edging higher in the months and years ahead. Now, what does that mean for the 10-year Treasury, the rate which is probably the most important one in the whole global financial system? Well, we think something in the 4 to 5% range, something around 4.5% is going to be the new normal in the years ahead. Doesn't mean there isn't going to be huge variation around that. If the Fed cuts policy rates, if that becomes the narrative for the next few months, it's going to impact long-term borrowing costs. But we think the new normal around which we're going to be fluctuating in the months and years ahead for the 10-year Treasury is around 4.5%.